You said this will be worse than the GFC. I was like, wow. Why do you think this will be worse?
In the lead up to the great financial crisis, mortgages were going bananas. You had LBOs going bananas. Investors in venture weren't to the same degree. You didn't see companies in the public markets in tech or the privates trading at, hundreds of times revenue. I think the dot-com era was too fresh in people's mind for that to happen. But this time it did. So the hangover is going to be worse because, you were pre-product and you raised at 300 on a bunch of hype. And now you're at $1 million ARR, but you had to cut burn. So you're only going to go to 2 next year. What happens to that company? Is that an up round? Is it even a flat round? It's probably more a down round. We already covered that the psychology for a lot of VCs is not to do down rounds. And so, man, those are tricky situations. And that's where I think a founder needs to be super proactive about figuring out the capital needs for the company and how to adjust that price in a way that's not going to, prevent them from raising that next round.
We're going to get to kind of the survival steps. I had Jason Lamkin on the show not too long ago, and he said anyone who joined a $1 billion startup as an employee in the last 2 or 3 years, I can't remember what his time frame was, but say 2 years, they won't make any money from their equity in 99% of cases. Do you think that's a fair assessment?
Oh man, maybe I'm an optimist, but I think it's a lot better than that. Why? Well, yeah, the initial equity grants could be underwater, but there's a couple things going on. One is those preferred rounds, that's a different thing than the 409A price that the options get set at. And I think the 409As may have been high, but not quite as high as some of the preferred rounds that venture firms did. So that's one thing. The other thing is it is in the power of the board and the CEO to figure out how to incentivize people going forward and make sure that employees are incentivized to stay and have upside. And so you can get creative there. And that's incumbent upon, the companies to make sure their talent's not going to leave, because if their equity is totally upside down, the best ones are going to be gone real soon.
So when the storm hits, we've got thunder and lightning. It doesn't look good. To carry that metaphor. What do the GPs do? How does this change what investors want in companies? And also, how does it change deployment cadence?
The deployment cadence is probably the first thing, and that's already changed. I think GPs saw that happening pretty quickly. So 21, there were a bunch of funds that deployed their capital in 9 to 12 months. And you say, well, why is that a bad thing? Why not just keep doing that? Well, because when you raise a fund, you generally tell your LPs, hey, it's going to take us, 2 or 3 years to deploy the capital before we go raise our next fund. And so that LP needs to allocate a certain amount of funds. Let's say they're an investor in your fund and they put, $5 million in, and they think they're going to put another $5 million in 3 years from now. But 9 months later, you said, hey, I need another $5 million. That depletes the books of the LP pretty quickly. Now, LPs start pushing back and they say, I'm not going to commit if you come back in 9 months. That's going to change deployment cycles. And VCs know that's already happening in the LPs' minds. So they're now saying, okay, I have to hit the brakes and I'm going to go back to that 3-year deployment cycle. And so that's dividing the dry powder out there by a third.